Okay, one rental per LLC can keep a lawsuit at property number 1 from exposing the equity in properties 2 through 10. But here's a question. Does owning 10 limited liability companies mean filing 10 separate federal tax returns? Oftentimes, no. Listen, I'm Clint Coons. I'm an attorney. I'm a real estate investor, and I'm going to separate the legal structure from the tax classification and show you how I would organize 10 rentals without creating 10 federal tax returns. Okay? Let's get started. Okay, so here's the thing. If you're wondering about this, why do investors want to use one LLC per property? What is the purpose behind that? Well, it comes down to this. You see, when you set up a limited liability company here, we'll just call this LLC number 1, and I put a property into it, and then I create LLC number 2 over here, and I put a second property into LLC number 2. Now, the reason why I would structure people this way when they come to me with rental property is because if something were to go wrong with this property, I want that liability to stay contained so that it doesn't expose the rest of my portfolio. And this is a mistake that I see a lot of real estate investors make when it comes to structuring their investment assets. They will take and they'll create one LLC and they'll maybe group 2 or 3 properties inside of that one LLC. And what they don't realize, and I've seen this happen before, is that when a lawsuit starts, let's say it starts with this property right here, then these other 2 properties you hold on that LLC, well, they're going to be exposed to that risk because everything stays contained in that LLC. So whatever is contained in that LLC is now exposed. So the preferred way of structuring, the way I do it, is I like to create one LLC per property. So if somebody had a portfolio, and I'll just put up here 4 properties, then we would create 4 separate LLCs just like this and put one property per LLC, so we're minimizing the overall risk exposure for their portfolio. Now, I do understand that when you set up LLCs, you do have an annual filing fee that you must pay. That's kind of a cost of doing business. If you think about it, right? Some are pretty low, depends on your state, and some can be quite high, like California. They charge $800 a year to have an LLC. But at the end of the day, I oftentimes will talk to people and say, well, what is that protecting for you, right? By paying that state fee, whatever it is, it's $50 or $800 a year, what is it providing you? What it's doing is, think of it as terms of insurance. It's protecting your portfolio. That is, if something goes wrong with this asset in my portfolio, that is the only asset that is exposed and is at risk. So this is what we're doing here. Now I'm going to get into the tax side of this in just a moment, because a lot of times people will then point out and they'll say, well, Clint, then you have to file a tax return for this one, a tax return for this one, and a tax return for all of these. And so now I have added costs, not necessarily if you do it the right way, which I'm going to show you. But I just want to get the basic structure down here because it's going to make a lot more sense when we start talking about the number of federal tax returns that you have to file. Now, the next thing I want you to understand with this type of structure, and if I was structuring somebody in that situation, I know we said 10, let's just talk about 4. I would create 4 separate LLCs, as I've already indicated. Now, what we want to do here, after we have the 4 LLCs, we don't want you to own them in your own name. Instead, what we want to do is we want to put a holding LLC here. So actually, you've got 5 limited liability companies set up. And you're going to see the benefit here in just a moment, because this is all going to the tax side. So you have all these LLCs up here that own your property. They're all going to be owned by this one holding LLC that I have down here. And this is actually where you will sit. You will sit at the holding LLC level, meaning you're going to own the blue box. And the blue box in my example is owning these purple boxes that actually hold the properties. Now, what is this doing for you? Why would you want to use a holding structure? Well, what it's doing is it's setting the base foundation in order to ensure we don't have to file multiple federal tax returns. That's just one benefit. You're going to see that here in a moment. But the other thing you're getting out of this, and many times this is often overlooked by attorneys who create these structures, they don't understand the benefit here, is you have anonymity. You see, when you set up these LLCs, say I set this one up in California, this one in Washington, this one in Idaho, and this one in Colorado. Well, in that particular case, excuse me, what's happening is that Each of those LLCs has to do a state filing. And when you file with the state to create the entity, the state wants to know who is the owner of the entity. So if I was going to be the owner of my LLC, then I would have to provide my name and my home address to the Secretary of State. And when you do that, that information then is searchable. That means it becomes part of the public domain. Every LLC you set up this way can be traced back to you. So a creditor, a tenant knows that you're the owner of that company and that company owns a piece of property. You do not want to have that information out there because that invites additional litigation. So we want to stop that, block it. And the way we do it is we use this holding company because we set this up in Wyoming, and this gives us anonymity. What do I mean by that? When you set up the LLC in Wyoming, Wyoming does not ask for the owners of the LLC. They do not request that information. They have nowhere to place that information on their state website so it doesn't have to be provided. So since you set up the Wyoming LLC and you give the state zero information, there is zero traceability back to you. Okay, see what I'm saying here? So the only thing that's filed is the name of the LLC and the registered agent. You're anonymous. Then when you create the California, Washington, Idaho, Colorado LLCs, you list the Wyoming LLC as the member of those companies. Now, when you're doing that, this is what's really important here to get to this tax status I'm talking about. You want to make sure that the sole member, this is a key term here, sole or single member, is the Wyoming Holding LLC. So when you draft your operating agreement for the California LLC, who is the member? You put Wyoming LLC 100%. Same thing with Washington, same thing with Idaho, same thing with Colorado. So everything points back to Wyoming. Wyoming then provides you anonymity because your name isn't listed on any of these filings up here. It all points to Wyoming. And then you get something else called charging order protections. That is phenomenal when you think about lawsuits because everyone focuses many times when they teach these videos, I've seen them online, they'll talk about, oh, somebody trips and falls on the property and they sue you, set up an LLC to protect yourself. Yeah, that's called inside liability. But remember, there's also outside liability. What happens if you get sued personally? Don't you want to make sure that your LLCs are protected? So you want to make sure we're putting together a plan that protects them both ways. And that's what you get here. You get the inside protection with this box, and you get the outside liability protection with this box. I mean, if somebody sued me, they can't break this LLC to get up to these LLCs over here, which in turn brings it to my property. So that's what we're doing with this structure, but it also leads into the tax aspect of what I'm talking about. Now, here's the thing about LLCs that you need to understand. Okay, so when you set up the LLC, when you create a limited liability company right here, okay, you're filing it with the state. Now that right there, when you file the entity with the state and draft the operating agreement, this is what's called the legal form of the structure. The state gives you the ability to conduct business under this legal form called a limited liability company. Now the IRS then is who you're going to be talking to elect how you want it treated for federal tax purposes, meaning how's the IRS going to look at this? Now, here's the mistake that happens a lot when it comes to setting up LLCs. And I see this over and over in my practice. People have created an LLC with their local CPA, their attorney, and oftentimes, here's a husband and wife that will come to us with these LLCs that they've created. And we look at it and we notice something right away that is costing them a lot of money on an annual basis to have this structure in place. And that is the LLC is set up as the LLC is set up as a partnership for federal tax purposes. Okay, so this is what you should understand about LLCs. You see, LLCs are what the legal community, the IRS, would term a hybrid entity. And what does that mean? It means that depending on the number of owners you have, members in the LLC, you have different tax classifications for that entity, meaning how the IRS will treat it from a federal tax standpoint. So you have 4 different options here. You have partnership, which I've already described. You have C corporation, you have S corporation, or you have what is referred to as disregarded. So, for rental real estate, passive real estate investments. The C Corp and the S Corporation tax status, these are no-go zones. We do not go there and making an election for this LLC. That means telling the IRS, hey, I want my company treated as a C Corp or an S Corp. You do not want to do that. Okay, now why do we not want to do that? Well, because there's negative tax implications for real estate to be held in a corporation, and it just will not work out well for you. I have other videos on that topic. The other thing about that is that when you choose an S Corp or a C Corp, both of these have to file a tax return. That's 1120. This one's an 1120S. Okay, so that again drives up the cost, and this is what people are trying to avoid. Now, the situation that I run into a lot here at Anderson is that when this couple comes into our office, the LLC that was set up for them, the person who set it up elected to treat it as a partnership for federal tax purposes, which means it files a 1065, which is a federal tax return. So what ends up occurring as their portfolio starts growing, they want to put one property per LLC. So they keep creating these limited liability companies as follows, right? And each of them is treated, thanks to their CPA, as a partnership for federal tax purposes. So that means in my example here, they have to file 5 tax returns. If you had 10 of these, you would file 10. Now here's the mistake. You see, when the CPA is working with this couple, what the CPA did is they set up the LLC with the couple as the members. And when you do that, when you set it up where there are 2 members, the only tax classifications that are available to you are these right here. Partnership, C Corp, and S Corp. C Corp and S Corp, no-go zone. That leaves us with partnership taxation. You see, the disregarded aspect down here, okay, that I haven't touched on yet. What disregarded means, and that's an election you make with the IRS, is that the LLC itself will not file a return. And the reason it's not going to file a return is because there's only one owner of that company, and that owner will treat all of the income and expenses associated with the assets inside of that LLC or the business activity of that LLC. They'll treat it as if they owned it personally for federal tax reporting requirements. So that means it just flows through and the LLC form is ignored for tax purposes. So it all shows up on your 1040. Now see, here's the problem. Husband and wife. So generally what you would have to do here is if you're working with these clients and they wanted to have 10 or let's just say 5 LLCs set up like this, it would have to be set up this way. Husband owned one, wife owned one. Husband owned one, wife owns one. Husband owned one. Oh, husband now has 3, wife has 2. I'm not sure that's going to work out very well for the marriage. In fact, typically it's going to be like this. Wife, maybe they give the husband 1. Wife owned 4, husband gets 1. Okay? But the fact of the matter is, you don't have to go through this scenario here and do all this creative, you get 1, I get 1 type of planning when you're setting up the structures if you understand how to set them up. And I've already shown you how to do it. Maybe you caught that when I was talking about the holding LLC. You see, to fix this problem, all we do is we create our 5 LLCs like I just showed you, but we're not going to have husband and wife owning those. We're going to have all of those LLCs owned by this Wyoming limited liability company. Okay, and we'll have husband and wife owning the Wyoming LLC. So look at how many LLCs I have on this page right now. I have 6. How many federal tax returns will this couple have to file? Well, think back to what I just told you. If you have 2 owners, what tax election are you allowed to make for your LLC? Partnership, S Corp, or C Corp? No-go zone, C Corp and S Corp, that leaves us with partnership right here. So they will file a 1065 for their partnership return, but now since all of these LLCs only have 1 member, these are all, what I'm going to put in here is a big D, all disregarded. See, this is how you can build a portfolio of 1 property per LLC. You can get it up to 10, 15, 20 properties, and you don't have to file multiple tax returns. That holding company is the key to unlocking this type of planning. Now, if you're watching this video right now and you're thinking to yourself, well, I've already screwed this up. All right. My CPA set it up. I already have 5 LLCs. What do I do now? Here's the thing. You can actually set up the structure that I just described right here, transfer your interest, transfer your spouse's interest into that holding company, and then you can convert it from that partnership to a disregarded entity so it no longer has to file a federal tax return. We do this all the time here at Anderson when we run into people who have found themselves in that situation, and we can do it for you as well. Hey, if you like this video and it's helped you understand the tax classification of LLCs and how you can build a portfolio with the maximum asset protection, be sure to hit the like button. If you're not yet a subscriber, well, you know how to do that as well. And if you would like to set up a time to speak with someone here at Anderson, in the notes, the show notes, I have a special link in there for a free strategy session where you can sit down via Zoom with one of my advisors here at Anderson, and we can go through your current scenario and outline a plan just like I've been showing you here on this video. So going forwards, you know that you have the best asset protection and the best tax classifications for your investing structure. I wish you all the best with your investing.